Head of Portfolio Advisory for Willis Towers Watson in the Asia region, primarily working with institutional investors, corporate pension funds, sovereign wealth funds, and endowments, foundations, that kind of thing, helping them with their asset allocation and portfolio design, as well as supporting them with implementation to find exciting new asset managers or through our implementation solutions. I'm really pleased to be here today. We've got an amazing panel, I think. We've had the opportunity to get to know each other a little bit over the last few days, and I think you're going to see some real insights come through from the discussion today on the private credit universe. Private credit is a key hot topic for many institutional investors that I work with, looking to make allocations, top up, very attracted to the market segment. We've seen huge growth in the market over the last 10 years, and that will likely continue, we think. But the key question is, are the returns attractive? Are they sustainable? And will allocators persist with the allocation through time over the course of the next few years? And time will tell. But I'd like to now just to turn to the panelists and ask them to quickly introduce themselves, their area of focus, and we will then get into the questions.
Great. Thank you, Paul. So my name is Juan Luis Rivera. I'm a managing partner at Patria. Patria Investments is the leading alternative platform in LATAM. We manage about $45 billion. We've been doing it for over 30 years, and we invest through separate funds, but in private equity, infrastructure, credit, real estate, and public equities. About 10% of our assets come from Asia, and it's actually our fastest growing region, so that explains why I'm here. And I'd love to discuss further with you on the panel and off.
Thanks. Hi. Hi, everyone. Thank you for having me on this panel. My name is Manu George. I hail from Polen Capital. I'm based here in Singapore. I'm a credit strategist for the firm, and our business is really investing across leveraged credit, both in the public space and the private space. So our flagship strategy is an evergreen strategy that looks for the best opportunities across public and private markets, but through direct investments into the markets globally. Thank you.
Good morning, everybody. I'm Randall Sandstrom. I'm the chief executive and one of the founding partners of SIMCo. SIMCo is Sequoia Investment Management Company. And what we do is we specialize in managing high-yielding infrastructure debt. And our main product is the largest listed fund in London. And in that fund, it's called SEQI. That's the ticker symbol. You can look at it on Bloomberg. That's SEQI. And what SEQI does is we make high-yielding loans to infrastructure projects around the world in global markets.
Good morning, everyone. I'm Hongfei Yan. I'm a managing director with VI Asset Management. VI is a $10 billion asset manager based in this Asia Pacific. We have our headquarters in Korea and operation in Singapore, Hong Kong. I'm based in Hong Kong. And I had our credit strategy to provide a credit facility to midcap company across Asia Pacific.
Okay, thank you. I'm going to jump into the questions now and talk a little bit about the outlook and the opportunity set. I'm going to invite Randall first to maybe just share a few thoughts here. Randall, you've been through several market cycles, and we're kind of in a particularly interesting point maybe in the cycle right now, but I'd like to get your views around the current macroeconomic and market maybe tailwinds that are helping to drive opportunities for deal flow in your particular area of focus.
Yeah, thank you for the question, Paul. I'd say some of the tailwinds right now, a couple of them would be, if you look at sort of the market economic side, rates beginning to drop. So that's really good in the sense that, a lot of the loans that we make are floating rate loans, and borrowers are very interested in paying as little of an interest rate as possible. So we are starting to see a pickup in our pipeline of lending opportunities as rates drop. In the US, for example, where we have most of our exposure, those floating rate loans are based over SOFR, and as that rate goes down, we would expect to see more borrowing activity pick up. Also with spreads as tight as they are, same thing. It's becoming a better time to borrow. On the policy side, just sticking with the US, for example, just a huge need for infrastructure spending. There's a fundamental imbalance of the demand for infrastructure capital in the US, which is really high, and the supply of infrastructure capital, which is significantly lower. So our exposure in the US is really about taking advantage of the lending opportunities that we expect to see as that gap, which is estimated to be about $3 trillion over the next 10 years, is plugged. We've also seen in year before last the Inflation Reduction Act, which really solidified the accelerated depreciation that renewable equity investors can get in their projects. So we're seeing an uptick in that line of business and the financing that those sponsors need as well. And that's in addition, lastly, to the infrastructure bill, which was in 2021.
Interesting, and maybe we'll come back in a few moments, because I would quite like to dig a little deeper into which areas within infrastructure you're particularly targeting right now. But I'm going to first quickly just invite Hongfei to maybe just share with the audience the opportunities that you're seeing in Asia Pacific specifically, but also how the marketplace has continued to evolve over the last few years.
Yeah, thanks, Paul. I think Asian market is always very dynamic. And what we have observed, I think, fundamentally, the opportunity in this part of the world is really driven by the growth. If you look at global GDP and everything, Asia is becoming a majority part of the growth driver. So even we are credit investors, we want to take that opportunities. And actually, that's quite different from a lot of the developed world. So for this part of the market, when we see high interest rate, combined with certain growth opportunities, we are actually very happy because a lot of these growth comes from what we call the midcap company. And that becomes a very interesting deal sourcing opportunity for us. So if you dive deeper into this market, you will see within this high interest rate and continuous sustainable growth environment, we'll find a lot of opportunity in the midcap market, where actually the supply of capital to support that growth is at scarcity, especially when the market comes down in terms of valuation. We see a lot of company comes to the market and essentially seek private credit as their support and provider of liquidity to support their growth. So to be honest, we see a very strong pipeline over the last, I would say, 2 to 3 years. And despite the fact that the interest rate is slightly coming down right now, we still see people, or what we call the promoter of these mid-cap companies, they prefer private credit solution versus private equity because the valuation is just not at the level like 2 or 3 years ago.
And in the marketplace that you're operating in, is it mostly working with promoter sponsors or directly with corporates?
I think for this part of the world,
sourcing deals?
I think for this part of the world, we work probably 80% directly with promoter. For sponsors or private equity, M&A type of deal is just 10 to 20% of our investments.
Okay. Many people in the room and maybe here at the event quite familiar perhaps with the US, European markets, the Asian markets. We're in Asia, but maybe less so with Latin America. And Juan Luis, I'd like to just ask you to share why you believe that market to be attractive and the opportunities that lie therein, and how it's different to maybe some of the other locations that people are looking at.
Yeah, thank you very much. So yeah, a previous panelist, I think it was Louis Gave, he was mentioning the misperceptions, and I think LATAM is one such example. So I'll just give you some data to get an idea. Latin America is, what we define as Latin America is Mexico to the south, to the bottom of Chile. It's about 650 million people, about $7 trillion of GDP, so around 7-8% of the global GDP. So it's a relevant region. There's about $1 trillion of corporate bonds outstanding. Just as a reference, US high yield is 1.2 trillion-ish. I looked at databases, there's 600, 700 US high yield managers out there. in our space, we're the largest by a distance, and there's maybe 2 handfuls of managers. So you can imagine it's a big pot, it's a more inefficient market, less liquid, so more alpha. So big alpha pot, few people chasing after it. So that's why one reason why we think it's interesting. We've been doing this in our flagship credit fund, similar to what Manu was saying. We also invest across public and private, and we've been doing this since the year 2000. And what we've discovered is that lending money to good quality corporates, at least in our zip codes, is a better risk than lending money to governments. And the nice thing is that usually corporates trade wide or pay more spread than sovereigns, so you're getting more spread to what turns out to be lower risk. If you compared the default rate in LATAM corporate bonds, for example, high yield, to global high yield, US, it's about half. So the default rate is 2.5 compared to 4.7, 4.8. So I think that's a big misperception. When I ask people, what do you think the default rate looks like versus the US, people tend to think it's a lot higher. Now, what's driving the market today? LATAM markets in local currency have gotten quite large, so a lot of companies have access to local funding, which I think is a good thing. However, after the resurgence in inflation that came after COVID, we have very high interest rates. So policy rates in Brazil are 11 or 12%, in Mexico 10, 11%, with inflation running at 3 or 4. So we're talking 7% real rates. So that creates a big scarcity of capital. It's a very different environment than what you hear in sponsored private credit in the US, for example. There's 20 managers that raised a ton of capital. They need to deploy, kind of fighting against each other for deals, terms suffering a bit in the process. So we're generally running alone. The private credit industry, in this $1 trillion of corporate publicly traded bonds, there's another $1 trillion of bank lending. The private debt industry through funds is only $15 billion, so very nascent. So big difference, scarcity of capital, you're running alone basically, and it's same as Hongfei was saying, it's non-sponsored, so there's very little sponsored debt in the region.
So how are you sourcing your opportunity?
It's proprietary. I mean, the platform's been investing for 25 years. We know almost all of the companies, 99% of the companies are family owned, so the promoter you were talking about, families tend to have more than one business, so if we haven't lent money to that particular operating company, chances are we have done stuff with the family in the past. So I think that's a key advantage. It's a relationship-driven region. Okay.
And Manu, at Polen Capital, you have the opportunity to go in many different spaces to find where the most attractive opportunities might be in this current environment and in the cycle. How are you looking to position the portfolio, given that you have the ability to look across everything?
So that's a good question, and actually, I was just thinking about the title, The Continuing Appeal of Private Credit, and for us, there's less and less of appeal of investing in private credit, particularly in the US, when it comes to mid-cap and large cap and mid to large cap investing. And this is driven by the fact that we've seen a dramatic increase in liquidity in the market. What used to get paid, we used to get paid for 400 basis points of equivalent credit risk in the public space. You're getting between 150 to 175 basis points. So a massive collapse in liquidity premium. Yet you are asking investors to lock up their capital for between 4 to 6 years or even longer. From our perspective, so where we find it challenging is actually investing much in the private market space, specifically, again, in the mid to large cap area. We do like the lower mid-market space, but that requires a lot more engagement with the company, a lot more credit analysis, a lot more documentation work. There are huge opportunities there. The other space that we find increasingly interesting are regions like LATAM and Asia, where, again, the liquidity premium is quite juicy. The credit risk premium is healthy, and conditions, if interest rates are coming down, are very positive for LATAM and Asia from a borrower's perspective, which also translates to possibly better credit conditions from a lender's perspective. So fundamentally, we have tilted our allocations increasingly towards the liquid side. We like broadly syndicated the loan market better. In the public space, we like high yield bonds better. And where we see opportunities really is more and more within specific markets in Europe, Latin America, and Asia. But they're very specific, and I wouldn't say that regionally we are a big fan of each region as a whole, but there is alpha to be had definitely in these spaces.
So selective in
Yes.
the approach you're saying. Okay. Randall, we talked a little bit about the opportunities and mentioned quite keen to get a bit more of an understanding of which parts of the infrastructure landscape you're really focusing on. Appreciate your thoughts on that, but also some of the comments earlier around interest rate exposure. And we've just had a period of quite high rates for a period of time. Is that causing any particular issue or challenges in the markets that you're operating in, and how are you managing that?
Sure, yeah, happy to discuss that. Yes, I think if you look at interest rates, which of course did go up a lot since sort of 21, 22, it hasn't really affected the infrastructure or project finance market very much. And the reason for that is that infrastructure is very covenant heavy. And one of the basic things that you do is that you require your borrowers, if they want a floating rate loan, and a large part of the infrastructure debt market is floating rate, require them to hedge that interest rate exposure. Most of the sponsors that we deal with are, the big global sponsors. They have deep pockets. They can afford these hedging lines, and they know about ISDA agreements, and they know they have the capital to set up for margin requirements, to have hedging lines. So, for the larger players, it really hasn't been a problem, the higher rates that we've seen. I think where that has been an issue is really more in the BSL market, the broadly syndicated loan market or the leveraged loan market, particularly for the smaller borrowers who really can't afford the capital to set up a hedging line. And for those folks, I think when rates went up, it was a bit more painful, but not really in the infrastructure market. Okay. And in terms of the second part of your question, Paul, in terms of sectors, just flipping back to the US, and really this is relevant around the world. It's the two big themes are energy transition and digitalization, and that's really the case pretty much across all of the markets that we lend into, from the US to the UK, Europe, and Australia, and New Zealand as well. Within those broad sectors in digitalization, and I think the current administration in the US is going to be tech-friendly, so I don't really see this changing at all substantially. Data centers have been a pretty popular area. We did our first data center loan years ago, early 2017. It's getting a little bit more of a crowded sector, but it's still very interesting. Mobile phone cell towers, with the advent of 5G and needing many more cell towers around the world, that's a sector where we've seen really solid growth. In addition to that, in energy transition, floating liquefied natural gas is an area where we've made some really interesting loans. And liquefied natural gas in general, particularly coming out of the US. A lot of that supply used to come out of Qatar, but there's a lot of supply coming online in the US. So we're seeing good deal flow from there. And on the floating rate, liquefied natural gas side, we're seeing good demand there as well. Those are a couple of examples.
Thank you. And Hongfei, I'd like to get similar from you where you're focused on the specific types of investment deals. But is the high yield environment also a challenge in Asia, and how does that
Yeah, so I guess I can first share a little bit about the challenge and the risk that we observe, to be very honest, because we are focusing on the lower part of the mid-cap market in Asia. We all see the big name going down in the public bond market, but to be honest, when you zoom into the mid-cap or lower mid-cap market, you actually see the situation or the default rate is not that challenging. In our view, mainly because of two reasons. Number one, if you look at the real leverage they have, it's typically much, much lower compared to the large cap or even compared to the more developed markets. So give or take anywhere between 2 to 3 times total debt to EBITDA. So that's still manageable despite the high interest rate. And second, similar to that, and basically 80% of the market is dominated by the non-sponsor backed deal. So we typically ask personal guarantee. So that actually aligns the interests of the promoter with the lender a little bit more. And in case of difficulties, it's easier for us to really go in and talk with the promoter and find a solution. So I think we are still seeing a quite healthy portfolio performance, not just for us, but across the region. If you look at the lower sort of mid-cap market. On the opportunity side, obviously, generally we see a very interesting opportunity for this market because of the scarcity of the capital. And in terms of particular sectors, one thing we really want to focus on is digital infrastructure. Obviously, we see that as a growing trend with a lot of capital pouring into it, and definitely supported by the economy and population of Asia-Pacific region. So that's definitely a sector we see a lot of opportunity for private credit to go in and play.
Thank you. And I'm going to maybe just ask Juan Luis, just the high yields, interest rates, cost of capital in Latin America that you mentioned earlier. I mean, how do you look at that and look at the opportunities and the deals that you're working on, and how do you manage that through time and all the different challenges and risks around that?
Yeah, maybe a couple of things. So context is leverage as a whole is significantly lower in the LATAM region compared to developed markets. So government debt is lower, consumer debt is lower, corporate debt. You know, the high yield universe in LATAM is maybe 3 times levered compared to 4 or 5 times in developed markets. In Asia it was 7 or 8 or 9, and you saw how that ended up. So for us, leverage is a big predictor of defaults, right? So if you have less levered companies, they tend to do better dealing with all sorts of volatility, not just interest rates. Another point I wanted to make, similar to what Manu mentioned, so we do both public and private. If you saw what happened coming out of the pandemic, actually our public deals or our public portfolio was yielding higher than what we were doing in the private side. So, that was kind of not so much drive to originate if you can buy it, because you're getting part of the return from a motivated seller, right? So there's not that many companies that can pay 15 or 20% as cost of debt for their whole capital stack. So if you're originating, somebody has to pay that, right? Whereas if you buy in the secondary market at a discount to par value, you're getting it from the seller. So that has reversed. So you see the headlines, US high yield trading at kind of all-time tight spreads. LATAM is tight, not as tight. But now the premium between private and public is probably the widest we've ever seen. So that's very interesting. One example along the digital side of things, we've been originating a lot in the telecom space, namely cell phone towers. Yep. So there's promoters that build batches of towers, and then they contract them with a mobile operator, and then they sell them typically to a tower company like Tower One or American Tower, people like that. So that's a very lucrative business. You kind of build it. It's costly to build. It's a lot of work. It's small sites. But then when you add them up, you can get a big uplift in value. So we're getting sort of 20% dollar returns, lending money to those via a bankruptcy remote structure whereby we own the towers. If anything goes wrong, we own the asset.
Got the security.
Yes, and we don't even have to go through Chapter 11 potentially. You just, the trust, which is held to the creditor's benefit, owns the towers and the contracts and the cash flows. So I think right now it's looking quite attractive in the relative value.
And just conscious of time, I want to ask Manu to also share a few thoughts around this topic that I'm going to just mention. So in the last decade, private credit has benefited from bank retrenchment and capital regulations around that. Is it likely that that can continue in your mind, or will the banks come back into the marketplace and really fight back for market share, or can they fight back for market share? How's that dynamic likely to unfold over the next few years? And can that be a disruption or still an opportunity?
So I think there's an element of regulation that we have to consider. Since the credit crisis, globally, there's been a push to make banks more utility-like and limit their ability to lend. And thereby, that's what really helped turbocharge private credit market globally as banks retrench globally, whether it's in the US, Europe, European banks leaving Asia, creates huge opportunities for others, such as ourselves, to enter. Will that continue? Possibly. We're going to see what the new administration in the US does. There's talk about deregulation. However, this is a large, corporates need to borrow. And now that you have a functioning private credit market, a functioning public market, at least within developed markets, there are multiple channels from which they can access funding that is relevant to what type of business they want to engage in. So I think it'll be nuanced based on the country. There'll be some regulation give, and other countries will add to regulation. But along those lines, on a flip side, actually, some more tighter regulation helping the private credit market is also helping another part of the market that maybe is not part of this discussion, which is the structured credit market. As banks and insurance companies, so Solvency II, Basel III, are forced to hold higher and higher quality securities, and that's really causing investors to start taking a serious look. Not causing, it's been happening for a while. And that's something that we're quite interested in, which is structured credit like CLOs, CLO equity, which are interest rate agnostic, offering double-digit returns. So this is other things that we begin to add to our portfolios as well. So using regulation both to access opportunities in the private credit space, but also in looking at other forms of credit instruments that, especially in a potentially falling interest rate environment, we're likely wanting to still juice up and keep returns attractive for our investors.
And just thinking through, I had a conversation with a colleague there not too long ago, and they made the claim that this private credit industry could potentially fall more under regulatory supervision, and maybe like banks be forced into areas that maybe they can no longer support because of maybe there might be some capital regulation or any, I don't know, but is that something you're worried about, or anyone else maybe?
Yeah, there's a push by the Bank of International Settlements to keep on ringing the alarm bells about the shadow banking system. The IMF and the World Bank have also opined on it. Regulators, particularly in Europe, have jumped on that as well. So again, it becomes a very regional thing, actually, I think.
Maybe it's a bit too far away than the here and now.
It's still early days, but there will be something that comes along eventually. It's inevitable as more and more people talk about it.
Yeah, in our region, bank lending to corporates is $900 billion, and private credit funds are $15 billion. So it's a different order of magnitude. We're not there yet.
And did you have a comment?
I think just to add to Manu's point, I think as private credit has grown a lot. The recent estimate, I guess, as of the end of last year, is about almost $2 trillion, and I think as it gets bigger and bigger, at some point, absolutely, I think more regulation is likely, and I think the sorts of things that regulators are going to care about are valuations. Who's doing the valuation? What's the method of valuation? How independent is it? It's going to be about governance. Who's actually running the fund? What are the risk management procedures? It'll be about transparency and about reporting, and also about liquidity. As private credit gets deeper and deeper into the market and starts to be distributed to retail, I think that's when you're going to see probably regulators take a lot more interest, particularly in those 4 points, and looking at liquidity. So it's bound to happen, but right now private credit is not really regulated that much, certainly a lot less than banks and insurance companies, but a bit more regulation is likely.
Okay, well, our time is up. I'm seeing in front of me here. I just want to say thank you to my wonderful group of panelists here today for sharing their insights and perspectives on the market opportunity and the outlook. And I just want to say thank you, and hope everyone enjoys the rest of the conference.
Thank you.